Hello, everyone, and welcome to this latest installment of the Sybiz Masterclass series. This one is all about tax management and the associated reporting. And yeah, it'll take about an hour, so we'll get straight into it. And thank you again for sending questions through in the registration process. One of the things we do a couple days out is we just go through the slide deck and reconcile that against what questions have been asked, and more often than not, we've covered everything that's been asked. So thank you for those questions. If you do have any questions as we go, you can whack them in the chat. We'll get to them. Just please include your email address. And yeah, just as usual, we are software developers, not your accounting and tax advisors. So please ask questions along those lines and direct anything more of a technical tax nature to your tax advisors. In terms of what we're covering, we'll give you a bit of an overview of the whole tax management process within Sybiz Vision. We'll have a look at a couple of the things that trip people up, talk about the cash versus accrual as well, and look at a few of the processing tips for some of the things that are maybe a little more obscure, and also talk about reconciliation, the reporting and associated transactions as far as closing the tax period is concerned. And we'll just have a couple sticky beaks at some of the country-specific stuff, which we won't spend a lot of time on. We'll just talk about that very briefly at the end. Okay, so the normal disclaimer, we are talking about tax today, so there's a few more words on this slide, but again, we are software developers. Sybiz Vision 2610 is going out in a couple days' time, so if you are watching this recording, I'm probably not lying on that third bullet point that 2610 is the latest version available, but that is just about to be released if you are watching this live. And yeah, so we always sort of cover the software based on the latest version available. So if you see some things that aren't available in your version, that would mean that you need to look into upgrading. And yeah, unfortunately or fortunately, we are sort of tackling tax from an international perspective. So the content, when we talk about tax, we're referring to GST and VAT and those type of taxes. We are head office is based in Australia, so a lot of Australianisms will creep in. So for those in other jurisdictions, we might talk about the BAS or the business activity statement. That's just your tax report, so your VAT return in other areas. Um, the ABN is the Australian business number, which is equivalent to a tax number. So like a VAT registration number if you're in the European continent. And general ledger equals nominal ledger. And we are going to be mainly looking at the Australian tax reporting, but the concepts are pretty much the same. So Australia is pretty complex in terms of its tax reporting, but that won't confuse what we're going through in terms of the stuff that we're covering. But we did need to sort of pick some sort of flavour to go through, and so we've chosen the Australian flavour. But again, the concepts are pretty much the same. Okay, so there's a lot of jurisdictions that are supported by Sybiz Vision's tax manager, so we will accommodate a lot of those in terms of setting up the tax reporting and the relative tax codes for the different jurisdictions. If you're from another country that's not supported out of the box, then Sybiz Vision can still accommodate that. It just means that you need to set up your own tax codes and tax boxes for your own reporting purposes. So that's just a little bit of background there. And essentially, the building blocks of tax reporting that all comes about from tax periods, the tax codes and rates, defaults, and the tax boxes from a reporting perspective, and also your reporting method, cash versus accrual. Did not see that typo with the tax versus accrual, but it should be cash versus accrual. There's not enough coffees in the world for this particular webinar. Um, and so just onto the tax periods, and I should just say before we get into this overview is that a lot of people seeing for the registrations have been using Vision for quite some time now. So what I anticipate you'll benefit from this session is there'll be little tidbits where it'll just help reinforce your understanding, or it'll give you that final piece of the puzzle to crystallize your understanding as far as the Sybiz Vision Tax Manager is concerned. Uh, so yeah, essentially your tax periods, they are totally separate from your accounting periods and must be configured. And it's not a huge issue if you forget to create a new tax year, because when you go to close the first tax period of a new tax year, if you haven't created the tax period, you'll get a warning saying there's no tax periods, and you can create them then and there. The system's smart enough to do what it needs to do, to treat it as if those tax periods were there from the outset. Um, so the reporting frequencies, they can be monthly, bi-monthly, quarterly, 6 monthly or annual reporting. So you've got that flexibility. And there's three types of different withholdings that can be reported upon. So you've got your GST and VAT, your general withholding. So in Australia, if someone doesn't supply their Australian business number, you need to withhold more tax from them when you make payments. And then from a payroll perspective, there is the PAYG or PAYE reporting as well, that can be supported from an Australian perspective with the instalment activity statements. And essentially, your tax periods must be closed as part of the reporting process. So unlike your accounting periods within Sybiz Vision, the tax period closure is quite a formal process, and it does change the data behind the scenes. It locks the data or the transactions to those particular tax periods. So it was asked a few times in the webinar registration process as to whether it's possible to undo a closed tax period, and it's not out of the box because there is quite a lot that happens behind the scenes. So what we have done recently is we've added an extra confirmation to basically make sure that you're not just on autopilot and going next, 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 click, click, click. You are sort of interrupted through that process where you have to confirm with a tick box, which we'll show you a little bit later, that you do indeed intend to close the tax period. We have had situations in the past where people have closed the tax period early and they thought, oh, well, I'll overcome that by closing another tax period and another tax period and another tax period. Unfortunately, it doesn't work like that. Yeah, a data fix would be required if a tax period has been closed prematurely. So just keep that in mind. And as I said, we have made it harder for you to do that in an autopilot sense with that additional confirmation checkbox. The tax codes and rates are the other piece of the puzzle. So common tax codes are automatically created for you upon database creation, and for most people, that's going to do what is required. But occasionally, we have seen through various economic circumstances, such as the recent COVID pandemic, some of the tax codes in some jurisdictions were changed to a lesser rate for a period of time, and so there is that need to make some modifications to tax codes, etc. But for a lot of people, it's just fire and forget. Once the database is created, you don't really have to worry about the tax codes because they'll do what is required. However, we do recommend creating a non-reporting tax code at 0% that isn't mapped to the tax report. So for example, cash book transactions from the wages clearing account, and for those type of transactions, which we will have a look at later, that new tax code for non-reportable should be linked to the general ledger tax codes. And I guess out of the box, it's only really something in the Australian jurisdiction, but the tax codes do support a tax on tax arrangements as well. If that comes into your part of the world, know that the tax on tax is already supported in Sybiz Vision. So just on that non-reportable tax code, you can call it whatever you like. So basically, it's just so that you can assign a tax code to transactions that doesn't get reported. One of the things that we'll look at a little bit later is people miscode these types of transactions to zero rated or VAT free or GST free. They end up going on the tax report, which is not what you want. So by creating this new tax code and not linking it to tax boxes, that yeah, solves that problem for you. So basically, as I said, most people, once the tax codes are created, you never really worry about them. But so if you do want to set up this non-reportable one, the tax codes do live in the lookup lists area under the general ledger section, and it's easy enough to create that new tax code. The tax defaults as well. So this is something that's worthwhile understanding. So there's various defaults throughout the system that affect the behavior in a default sense. So even if something was set to say you've got an export customer, and for whatever reason, if in some jurisdictions now, if it is a B2C arrangement, you may need to charge them your local tax. And so there's different settings that can act as defaults, but then be overwritten as the transaction dictates. So there's system defaults in the ledgers for taxable, non-taxable, and the export-import tax codes. Inventory items themselves can be configured, and same with general ledger accounts. And essentially, we strongly recommend that you do that for exceptions. So if you do have some items that are zero rated in your inventory, then definitely put that at the inventory items themselves, attribute the sales tax code and purchase tax code as may be necessary against the inventory items. That will just save you from having to worry about it on a transaction by transaction basis. And similar, as I said, with the general ledger accounts, you should attribute that non-reportable tax code for those accounts that should be treated that way. We'll give you some examples of that in a moment as well. And customers must be set to the appropriate taxable, non-taxable, or export, and similar with suppliers as well. So that's not an optional field. You do need to make a selection when you set up new customer and supplier accounts. And essentially through all those combinations, that drives the default behaviors from a transaction perspective within Sybiz Vision. And so, yeah, essentially, if you get your configuration right and you handle those exceptions, then you should really, virtually never have to worry about changing the tax codes in transactions. The system should just take care of itself. Um, so there may be some things at the moment where you are having to make those changes, but doing things like setting up that non-reportable tax code will make life easier. Should just mention as well, if you do have templates, etc., you may need to update those with that new tax code as well. Just letting you know that. And just I've talked about it a couple of times. The tax code default on the general ledger account. So you'll see the little tax code field over on the right hand side, and I've got my non-reportable tax code. So where that comes in handy is if you are doing transactions to general ledger accounts in the cash book, for example. The cash book kind of defaults to a tax code. You can clear that tax code if it's not relevant, but it's easier to set the system up as I've prescribed. Set up your non-reportable tax code, attribute that to the relevant general ledger accounts, and when you go to do your cash book transacting, it's all set and forget. You don't have to worry about clearing that tax code or perhaps misreporting something as zero rated. Or I guess the flip side as well, accidentally putting tax on something that does not require it. The tax boxes is the next piece of the puzzle. And essentially the tax boxes can be thought of as fields on your tax report. And so that's just the mapping under the tax manager area of the general ledger, the tax code assignment. And that allows you to configure whereabouts you want tax codes to report. And again, for most people, you don't have to worry about touching that. But if there is something, as I said before, a change in tax rates or whatever, or new tax codes come in that are reportable, then you would need to assign them through the tax code assignment. Australia also allows the tax boxes to be mapped to general ledger accounts. So if you are in other jurisdictions, the account assignment button that you see there will be grayed out. That's just meaning it's not relevant to your jurisdiction. Yeah, I should just point out that that is a different premise entirely to what we just looked at in terms of assigning a tax code to a general ledger account. So because it's Australian specific, and yeah, it's not worth going into too much detail there because it will confuse people. From a reporting perspective, yeah, essentially reporting is initiated via the closed tax period function. Now that's a little bit counterintuitive, but yeah, essentially your reporting is at the end of a tax period. So you're essentially saying, I want to go through a formal process of closing that tax period off and completing my reporting. So the cash and accrual methods are supported. And essentially, the way that it works is that the system will sweep up any of the transactions within the tax period that you're closing and any backdated transactions that weren't reported from previous tax periods. So if you complete the previous tax period and then you backdate a transaction into a date range that would have naturally been reported in that tax period you've just closed, then that transaction will be reported in the next tax period. So that's the way that that works. And hopefully that would just be very exceptional circumstances where you do need to backdate something that has a tax effect, given that most tax periods have a buffer of a couple of weeks before you actually need to report them after their end date. So yeah, so essentially, we'll look at all these things in a bit more detail toward the end of the session, but the tax box totals can be checked via the drill down, so you can do spot checks at that level. A lot of people don't know about the drill downs, but we'll explain those. And with the exception of the United Kingdom with their Making Tax Digital, essentially the way that Sybiz Vision works is you produce your report and then you just log on to your tax office portal and transcribe those figures into the systems that the tax officers provide. Cash versus accrual. Um, we'll talk about this a little bit flippantly in terms of switching between one and the other, but yeah, there are rules in different jurisdictions as to which businesses are permitted to use which methods, and there are also rules for those that are able to use both. You generally can't just on a dime flip between one and the other. There is a process that you'll need to go through, so just check with your tax authorities in your jurisdictions as to the rules and regulations around that kind of changing of approaches. So essentially, all the different methods do, in the fullness of time, you'll end up paying the same amount of tax. But as you go along, the timing differences will come into play in terms of the accrual method essentially reports the tax and creates the liability at the time the underlying invoices are raised or input into the system, irrespective of whether they are paid or not. Whereas the cash method is essentially creating that liability to pay the relevant tax at the time that the underlying invoices are paid. So for cash flow purposes, yeah, in most businesses, you would hope that they are in a situation where they're having to pay VAT or GST at the end of each period because they've collected more from customers than they've dished out to suppliers. And so the cash method essentially just gives that little bit more protection in terms of cash flow, where you're making sure that your customers have paid you before you've got the liability to forward that tax on to the friendly neighbourhood tax office. So under general ledger defaults, if you are going to be changing this or you wanted to double check what arrangement you have, it's just under the business activity area. And that's where you toggle whether you're using cash accounting or not. As I said, don't just change that on a whim. There is a process that you'll need to go through. And when we get to the reporting section, we will talk about the differences between cash and accrual using some examples as well. And just some of the common misconceptions that we'll go through. I won't read out this list. We'll look at them in detail in the next few slides. So the inclusive and exclusive pricing. So generally, in a business-to-business context, most organizations will use exclusive pricing, and the business can to consumer context uses inclusive pricing in most cases. At the end of the day, tax needs to be conveyed at some point, but yeah, certainly there is the ability within Sybiz Vision to toggle between inclusive and exclusive pricing modes. Um, so if you are doing some trade sales and also retail sales from the sales side, you can flick between the two. You can enter and store prices exclusively and or inclusively, and the system remembers the mode used by the user. So if you do toggle in transaction processing, it will remember what you chose next time you go in. So it can require a bit of attention if you are in an organization that does switch between the two. And in some organizations, from a sales perspective, you may stick with the one mode exclusively, but then from a supplier side of things, you don't really know what you're going to get delivered by your suppliers. Some of them may be inclusive, some of them may be exclusive, so you toggle the mode. That'll make your life easier from a data entry perspective. And as I said, prices can be entered and stored both inclusive and exclusive if you so choose. The other thing that creates a little bit of confusion from time to time is whether tax is attributed at the line level or the total level. And yeah, essentially both methods are acceptable. It is quite funny. Sometimes people will say, "Oh, you're doing it wrong because it's line level," and I've got this document from a supplier um, that has it at total level. Therefore, Sybiz Vision is doing it wrong. That is not the case. In some respects, line level is more accurate. But yeah, so just essentially, yeah, the line level has been chosen within Sybiz Vision just because that is what we prefer. But if you do get a purchase invoice that treats tax at the total level, then there are ways to make your life easier to enter that into Sybiz Vision as well, and we'll touch on that a little bit later as well. So the non-reportable versus the GST VAT free. I've just got a little bit of a list here on the right-hand side. Again, apologies that that's just Australian, but similar things in other jurisdictions of the types of transactions that aren't treated from a tax perspective, from a GST VAT perspective. And so those quite often we see them tagged in Australia as GST free, and they get reported on the tax report, but they're not required to be reported. So you're actually misreporting if you are doing that. So set up that non-reportable tax code and make sure that the types of transactions listed there are tagged accordingly. And yeah, as I said, if you're in a different jurisdiction other than Australia, just check with your local authorities for a similar list of those types of transactions. Excuse me while I just take a sip of water. Okay, mixed tax treatments is another thing that gets a little bit confusing as well. We'll have a look at this a little bit later using an example as well. So sometimes the tax total doesn't make sense in terms of multiplying the uh, tax rate by the total of the invoice, and yeah, we'll look at that with an example. But yeah, a couple of things to point out here is Sybiz Vision doesn't allow the tax amounts to be modified. So if your VAT rate is 23%, the system will calculate 23%. And even for whatever reason, if you'd been charged 20% and you wanted to modify the rate, you can't actually modify the tax amount in the tax box itself. There are ways to enter those transactions, but we'll look at that a little bit later on. The tax periods and accounting periods, they are mutually exclusive, so they are totally independent of each other. They may be identical in terms of start and end dates. And as I said earlier, if you forget to create a new tax year at the outset, it doesn't matter when you go to close the tax period. You will get told that you don't have any tax periods available. You just create them then and there. And if you create them and you realize that you've set them up as monthly instead of bi-monthly or quarterly instead of monthly or whatever, you just right click, delete, and then create them again and get them right the second time around. So as long as you haven't obviously closed the tax period within that tax year, once you've closed one tax period, your tax year is then set. Um, so just bear that in mind. And yeah, as I mentioned earlier, we've got that new confirmation checkbox to make sure that you're closing a tax period deliberately and not inadvertently. And even though we talk about a tax year, a year as such isn't necessarily formal unless you are reporting on an annual basis. But yeah, if you have anything less than an annual reporting frequency, then yeah, tax year generally doesn't mean anything. So it's the reporting frequency that is of the utmost importance. So if your tax year doesn't match your accounting year, it doesn't matter. And backdated transactions, as I mentioned previously, if a transaction simply isn't in the system at the time the relevant tax period is closed, then it gets swept up in the next period. And yeah, just some jurisdictions may have additional reporting requirements if those amounts are material. So check with your local authorities, but other jurisdictions have an annual reconciliation process where that all comes out in the wash, assuming that it wasn't the final tax period that you've messed up there. So processing tips, again, we'll just jump straight into this rather than reading that list. We'll go into these things in detail. So let's just jump in. So the inclusive and exclusive pricing modes. So when you're in doing your sales and purchase transactions, you've got your show price area here. So you can toggle between exclusive and inclusive. Yeah, don't recommend doing that just for rainy day fun. It is something that you'd want to be doing deliberately and thinking about why you're doing it. And yeah, making sure that yeah, you are aware of which mode that you are in. And yeah, there's different reasons for why you'd be doing flicking between the two. I guess the most common that most people can relate to is if you do get a tax inclusive purchase invoice, or the prices are inclusive because it's come from someone else's system and they mainly deal in retail, then yeah, it just makes it easier to enter those purchase invoices if you flick to inclusive pricing mode. And the line versus unit price cost. Now, this is something that not a lot of people know about, and yeah, you probably most people, this will be one of their key takeaways from this session, is the ability to enter pricing on a line basis as well as the unit price basis. So if you have a situation where the quantity multiplied by unit cost doesn't equal the line total, um, then yeah, that can happen. There are some quirks in the way, depending on which tax rate, there are some numbers that you just can't arrive at if you use, say, exclusive unit pricing and then multiply it by a quantity, you don't get the extended price that is on your supplier invoice. So that's why we have the extended price column as well, which you can put on to your transaction grids. And so you'll see here I've got two of an item that has a $4.99. And again, apologies for the Australian currency there, but $4.99. And my extended price from my supplier was $9.99, which doesn't make sense because 2 times $4.99 isn't $9.99, it's $9.98. So that extended price, when you put it on your grid, not only does that sort of automatically calculate based on the unit price and the quantity, you can overwrite that as well. So if you did want to arrive at that $9.99 for the line because that's what your supplier invoice says, then you can overtype that and that all comes out in the wash. So that's pretty handy to put those line level totals in. And you can do that from the sales side as well if you did want to sort of have a particular number that was different to what the system calculates. I should just say as well that if you do change that number, it will go back and update the unit price if the amount is significant enough to change that unit price. If it's not, it will leave it alone. So it all depends on the quantities, etc. Handling of tax-only invoices. So this is, I guess, similar to if you do encounter rounding issues, you can use similar types of adjustments here. So here we have a scenario where we have a tax-only invoice. So it's quite common where a customs office will issue a tax-only invoice, and so you have a situation where you don't actually have uh, anything else other than tax. But so here, I'm just demonstrating that if you have a line item that is attracting GST or VAT, and then a negative line item for the same value that doesn't attract VAT or GST, then that will give you a total that is essentially tax only, and that is the way to handle those situations. So even though you might just get one line on that invoice from the customs authority, you do need to split that into two lines when you enter that transaction. Cash book reversals and tax. This is another one of those sort of hidden things that you may not know about. And so essentially what this is all about is in Sybiz Vision, if you need to reverse a receipt or a deposit, you do that with a payment and vice versa. In the event that it is something that's flowing through to your tax reporting, so generally that's a general ledger transaction that's entered in the cash book. If you are needing to reverse that, then to make sure that that hits the right box on your tax report and gets treated as a true reversal rather than a customer or supplier transaction, then what you do is you just put the tax method column onto your cash book and you choose the tax method of reversal when you are processing that reversal. So again, that's just a little tricky thing within Sybiz Vision. So that again is only when you are reversing a mistake. So that's not to say that you do that every time you do a payment or deposit. It is only when you are undoing a payment or deposit that you want to reverse the tax treatment as well. Mixed tax treatment. So here is an example of an insurance invoice has been received. It totals 1,400, but the tax is only 100. And again, apologies, Australia's got a nice easy 10% tax rate. So that's why the maths is a little bit easier from an Australian perspective. But so essentially what we have here is we have a component of the invoice that is subject to tax, and then we have this 300 stamp duty that isn't subject to tax. So that's in my list of non-reportable transactions. And so, yeah, essentially, again, it's a matter of splitting that into two lines. Again, I can't just put in $1,300 exclusive in the first line and yeah, beat the tax into submission down to 100. That will not work in Sybiz Vision. I need to accept the system calculated tax if I'm saying that tax applies. And yeah, so I need to split it into two lines, one for the tax applies and one for the non-reportable line, or it could be a zero rated line, depending on the nature of those components of the invoice. But I'm just using this insurance example as it is quite typical. Offsetting and tax. And yeah, so one thing just to be mindful of, and again, offsetting, I should just emphasize as well that especially if you are doing tax reporting, you should be very much on top of your offsetting because it's that connection of the cash transaction to the underlying invoice or other transaction that drives the tax reporting. So if you don't offset transactions, there's no tax treatment from the receipt itself, and so it's the offsetting that you need to do in order for the system to know the relevant tax treatment from that money that has been received or indeed paid. But be very careful when offsetting, especially if it involves discounts or foreign currencies, because those offsets cannot be undone. So just bear that in mind as well. And so the reason for that is that tax calculations relating to discounts are quite complex, and it's just if we were to unallocate them and unoffset them, it would get things into a real quagmire. So the system prevents those particular offsets from being unallocated. So you can still, with additional transactions, get everything back to where you wanted it to go, but just that won't be through unallocating. So you can still uh, get to the outcome that you desire, but it just needs transactions to get you there. Okay, just rounding the corner now into the closing of the tax period. So we'll spend a little bit of time on this section and talk about the reconciling, the reporting itself, and also some recommendations as to the transactions associated with the reporting and the payment. So let's just jump into that. So closing the tax period, again, a few of you asked, can it be undone? No, it cannot, just because there is quite a bit that happens in the background. Uh, from an accruals perspective, it's not as much of an issue if we do need to undo a tax period that has been closed inadvertently. There's still a lot of work that needs to happen behind the scenes from a data fix perspective. Um, but from a cash perspective, it's incredibly complex. And so in terms of everything that happens with the data when you close a tax period, so that stands to reason that's also incredibly complex to undo that. So please don't close a tax period if you don't mean to do it. And yeah, so essentially, unlike a financial period when you close one of those off, where Sybiz Vision is quite dynamic, the data from a financial perspective doesn't have that sort of strict tagging that you get with your tax periods and your tax data. Um, and yeah, so one of the reasons for that formality from a tax reporting perspective is that if you do change methods, consider the situation in which an invoice um, has been raised at the prior to the end of the previous tax period when you're on accrual. So you've paid the relative tax for that invoice, and then you change the tax for the change the cash basis for the new tax period, and that invoice is then paid. You don't want that to be subject to reporting again. So the system knows that that particular invoice has already been reported, so it won't get picked up when you've changed the cash basis in your next tax period. So yeah, hopefully that sort of emphasizes the reason for everything that happens behind the scenes there. Um, so yeah, and again, just to touch on the backdated transactions, if they are posted after their natural tax period is closed, then they will be reported in the next tax period. So um, an important thing as well, if you did want to go back and check the calculations sheet and the drill down, you can still do that after a tax period is closed. You just go to the tax periods area of the software to see that. Okay, from a reconciliation perspective, we do get quite a few questions about this, and yeah, we have a few pointers for you, which we'll have a look at with some data, just to solidify these concepts as well. But hopefully you've seen through what we've covered so far that if you do take the time to configure the system correctly, then the default behavior is pretty much going to automate everything that you need. So you don't have to worry about those exceptions tripping you up because you've configured your system with the defaults in things like your general ledger accounts and your exceptions in your inventory items, for example, that may be zero rated or GST free. So taking the time to configure the system will make life a lot easier. Obviously, reconciling the accrual basis is a lot easier as well because, yeah, there's not things like part payments and stuff like that in different tax periods that you need to worry about. And so it is a lot easier to reconcile the accrual basis. The cash basis is quite complex, and yeah, things like the part payments and mixed tax treatments make it even more so. And offsetting is vitally important. So if you've forgotten to do your offsetting, you may not get items reported. So make sure that things are offset accordingly. And Yeah, so essentially, we'll talk a bit about how to sort of check things as you go through this process as well. And yeah, if you follow a formal process and have your default set up, it is a lot easier to not only identify things that look abnormal, but get to the bottom of them is also easier if you've done that preparation. And yeah, essentially, if there are adjustments that are required to your reporting, then make them transactionally. So that's one of the features of the Making Tax Digital in the UK is that you can't just fiddle figures on a report. They need to be transactionally verified. And yeah, we recommend that in other jurisdictions as well. So the drill down, again, surprisingly, some people don't know about the drill down capability, but essentially it's just in your calculation sheet. You have this little ellipsis and you can click on that and then that will show you the underlying transactions that make up that particular ellipsis. It does get a little bit funny sometimes with some of the tax boxes that are a conglomerate of different reporting treatment. So you will see different transactions for different tax codes in the same drill down. So just be aware of that. As we have here, we have two different tax boxes um, that are in this particular drill down here. So just bear that in mind. But yeah, essentially the drill downs are a good place to start. If something does look a little unusual, um, then the drill downs will help you identify what's going on there, and you can export those and do all sorts of things to help get to the bottom of issues that may arise. Um, so this particular example here, I've closed my tax period and this was a quarterly tax period at the end of March. There were a couple transactions dated 31st of December from the previous year. So even though they didn't naturally belong within that tax period, it's just illustrating in isolation the fact that the system will pick up the backdated transactions when you do the next tax period closing. And yeah, same scenario, but from a cash basis. So those same transactions don't get reported because they haven't actually been paid yet. So that's just showing you the different behavior based on the different treatment from a tax reporting perspective. So your reporting and associated transactions. So yeah, let's just say it's today. This webinar's on the 8th of May, and we're doing our tax reporting for the period ended 31st of March. So we've done our reconciling, we've made the corrections that we need, and I'm just using very simple figures here. We've got a tax report that shows us a payable amount of 800 and a receivable claimable amount of 500. So this is just a recommendation in terms of, yeah, I'm not offering accounting advice. It's just this is my personal preference where I would, yeah, naturally do a journal dated that final day of my tax period and essentially have a clearing account for the amount that I'm going to be paying to the tax authorities, where I transfer from my liability account and also my receivable account the relative amounts that are payable for that particular tax period. And I'll just show you how that all sort of comes together. But then I'd process the payment against that clearing account at the time of making the actual payment. So just a couple of things on the closing the tax period. And again, this is the Australian example where we have a lot more tax boxes than most other jurisdictions. I think only Sri Lanka probably blows us out of the water. But yeah, so in that sense, apologies if you are in a country with a lot more common sense like the UK or Ireland, where there's nowhere near as many tax boxes. But yeah, as essentially, uh, yeah, the um, yeah, one point to illustrate here, I did make the point earlier that you can't just force the tax amount that Vision automatically calculates in a transaction to be whatever you want it to be. Because what happens when you go to your reporting in the Australian sense, and again, this is similar in others, is that when it comes to the GST or VAT on sales, it's taking the total of transactions that are subject to GST and then saying, okay, we don't care what you've calculated yourself. You've told us that you've got this amount that's inclusive, that's subject to GST, so we're going to just take 1/11th of that. And so even if you could manipulate the figures in the tax calculations that Vision makes, the system would just ignore it based on the tax rules of Australia and just go, okay, well, you need to pay 1/11th GST, don't care what you've put in the tax box. The yeah, the rules of the land are that we will tell you how much tax to pay. So that's why we don't allow the manipulation of the tax figures when you're processing transactions. Another reason. And yeah, so that is a little bit, and yeah, we'll show you just on the next screen. This is the activity statement. Again, very complex from an Australian perspective with all the different boxes, etc. But essentially, I've got my GST on sales and my GST on purchases nicely isolated here. And then we have the allow period to be permanently closed button that is, or checkbox that is there now. So until you actually put a tick in that box, you can't click the close tax period button. So it's making it pretty difficult. If you wanted to close the tax period inadvertently, you need to take an extra step. So we've just put that in to make it harder to inadvertently close that tax period. When you click the close tax period, it generates the report. Saving will generate the report, but not actually close the tax period. So the save button will be enabled if you haven't checked the allow the period to be permanently closed. And you can regenerate the report from the General Ledger's Tax Manager statement report after the periods have been closed as well. And you can come back to the periods after they've been closed and invoke the drill downs if you wanted to double check things. So in terms of, as I said, my personal preference is to do a journal for the receivable and payable amounts and allocate them to a clearing account as at that period end date. So so I've got my liability in terms of the tax that I've collected from customers that I need to pass on to the tax authorities, and then I've got the amount that I can claim back, which nets off to the net amount that I need to pay when I submit that particular tax report. And again, I'm just using simplistic figures to make the example more illustratable. So yeah, essentially I've got those journals now on the 31st of March, and essentially what I'll do when I go to pay it is I'll pay against that clearing account when it comes time to pay it as well. So, and I take this approach irrespective of whether I'm doing cash or accrual. Yeah, so essentially, what that means from an accrual perspective is that when I go and look at my balance sheet on the 31st of March, I should have pretty close to zero in my liability and receivable accounts because I've transferred that to my clearing account. From a cash perspective, though, it's going to be totally different. You are going to have residual balances in your liability and receivable accounts. So just bear that in mind. But we'll talk about how to sort of get a bit more of an indication of how to reconcile those figures. So after you've done those journals, as I said, it just allows you to see what those balances are at the 31st of March. Yeah, I can see my relative closing balances in those accounts. So this is just illustrating from the cash basis where I've got a couple invoices from both the sales and purchase perspective that haven't been paid yet. Therefore, I've still got those closing balances in my receivable and liability accounts as at the 31st of March. So I've only transferred the amounts that had been treated from a cash counting perspective to my clearing account as at the 31st of March. So as I said, if you are using the accruals basis, then you would expect to see those balances, closing balances, to be close to zero for the receivable and liability accounts. When I say close to zero, there's potential for some rounding differences. It's up to you as to how you want to treat those. If it is something more significant than something that can be chalked up to rounding, then that's indicating that there's something for you to investigate. So you'd want to sort of drill into those transactions and try and find out why those differences exist. But that shouldn't be the case in any case. Okie dokie. So just having a look at one of the challenges in reconciling. So we used the example previously of our insurance invoice. So here, so I've just got a little trial balance extract here. It's saying that my current balance of my sundry creditors is 1,400, but my GST receivable is only 100. So from an Australian context, I would expect if something was attracting tax that I'd be seeing a receivable amount of 127.27, but I only see 100. So I've got something that doesn't quite make sense to me, and I want to reconcile it. So one thing I can do is customize my aged creditors and aged debtors reports to show the tax attributable to the outstanding items. And so when I run that age balance report, I can see the tax amount and reconcile that through to what I'm seeing from my general ledger trial balance. So that's one of the reconciliation things that you do just to make sure that the balance that you're carrying in those receivable and liability accounts are making sense in terms of the tax attributable to the outstanding amounts from a debtors and creditors perspective. So obviously this could be a lot more complex. I'm just showing it as a illustrative example. A couple other reports that you have in the system as well is you have the tax history report. So this essentially gives you a tax code centric report for the date range. So it is based on the date range that you provide rather than tax periods themselves. And you can use this report in the cash or accrual basis, so the values will change accordingly. So that's the tax history report. And then a very similar, the tax manager detailed report that gives you a very similar take, except it takes a tax period perspective. So you nominate which tax period you want to see the tax history for. So it will, essentially be more in line with those tax periods, and it will only show the tax codes that are reportable. So if I flick back to the previous slide, you'll see I've got my non-reporting tax code coming through my tax history report because it's not based on my tax period reporting. But when I do my tax manager detail, which is based on my tax period reporting, I don't actually see my non-reportable tax code because it hasn't been subject to reporting. So it's not assigned to a tax box as such. So that's a little bit of a difference there. But again, if there is something to reconcile, you may be using a combination of these reports to try and get to the bottom of. So just bear in mind that they do exist and have subtle differences in the way that they work. And just finally, our final slide, just to talk about a couple examples of country-specific functionality within Sybiz Vision. So in the UK, we have Making Tax Digital, which is essentially a process to lodge the VAT return directly with HMRC. And essentially when Making Tax Digital came about, one of the drivers for that was HMRC were saying that mistakes in VAT returns were costing about £30 billion per year. And they thought if they just digitise it, that will cause that not to occur. But I don't think it's actually made too much of a difference in terms of the amount of VAT that's underpaid. So that's just for the UK. So if you do Obviously, if you're based in UK, you know all about it, but if you're thinking of setting up a subsidiary over there, uh, bear in mind that Sybiz Vision does support that UK tax reporting. In Ireland and New Zealand, we have the VAT and GST returns. For those in Sri Lanka, there's just been some changes to tax invoices where all amounts need to be um, rounded to the nearest rupiah, I think. Apologies if that's not the Sri Lankan currency, but I'm pretty sure it's rupiah. And then in Australia, we've got a few other idiosyncrasies. So we've got our business activity statement. We do have also the taxable payments annual report, and we support tax on tax. So examples of that are the luxury car tax and wine equalisation tax. So, yeah, with that, obviously we could have spent the entire day going into more detail on reconciliation and things like that, but hopefully it's given you a good overview and given you some key takeaways as to making life easier from a Sybiz Vision tax reporting perspective. Yeah, if you go through and just check your defaults, add in that not reportable tax code, and check the relevant general ledger accounts or nominal ledger accounts, depending on your jurisdiction. Change those defaults so that the system behaves accordingly. That will make your reporting easier and your life easier when you're entering transactions. And we also have a quiz we'll send you a link to. And yeah, we have pretty much taken up the hour, so we won't take any more questions live. If you have asked those questions in the chat box, hopefully they've been attended to. With that, we do have a couple other webinars on the horizon. So for Australia, we have our Payday Super and Sybiz VisiPay 2610 webinar on Friday, the 22nd of May. And then the Australian financial year will be doing that session a month later on a Monday for a change, just to sort of separate it from the mad rush at the end of the financial year. And so that'll be on Monday, the 22nd of June. So with that, whether you've tuned in live or watching the recording, thank you for tuning in, and all the best. Thank you very much. Goodbye.